Hello, and this is Global Business Insights, where we look deeper at the headlines from a business perspective. Indeed, we get consumer price inflation figures today on both sides of the Atlantic. Earlier, we had the UK inflation CPI increasing to 2.2% in July from 2% in June of 2024. Later in the day, markets are hoping core US July CPI will ease further. Yesterday, the US formally notified Congress of more than $20 billion in weapon sales to Israel, another catalyst for US defense industry as tensions rev up in the Middle East. And still in the US, as we await today's consumer price inflation, wholesale inflation, that's the producer price index, slowed in July. PPI was 2.2% compared to 2.7% the month before. Producer prices gave a view of prices that businesses are paying for goods and services and will feed into what will be passed on to consumers. Like I said, US CPI comes out later in the day. As PPI was lower than expected, we saw stocks rallying in relief across board, with tech leading the charge. Home Depot lowered its expectations for the year, reporting another quarter of muted earnings as shoppers held off on major home improvement projects amid high interest rates and tighter wallets. Reported revenue of 43.18 billion fell short of 43.79 billion that was expected, while earnings per share at $4.67 beat estimates of $4.52. The Zurich-based banking giant UBS announced that Q2 net income was $1.1 billion, about double analyst estimates. In the quarter, the main wealth management business saw strong client inflows with $27 billion in net new assets. Alphabet's Google yesterday unveiled a lineup of new Pixel smartphones embedding AI, including features that lets users search for information stored in screenshots. Users can also pull up Gemini, that's Google's chatbot, on top of another app to answer questions or to create content. Nigeria Central Bank announced that it was reintroducing the publication of several key economic data reports to better inform insights. Welcome back. Just out this morning, UK Consumer Price Index rose at an annual rate of 2.2% in July after increasing by 2% in June. The reading was below expectations of a 2.3% growth and back above the Bank of England's 2% target. When the Bank of England Monetary Policy Committee met last month, they decided to trim, as expected, the bank rate by 25 basis points to 5%, as inflation held at 2% in May and June, also the central bank's goal. Month on month, in July, saw the CPI down by 0.2% after a 0.1% acceleration in June. Core CPI, that is excluding volatile food and energy, advanced 3.3% year on year in July compared to a 3.5% increment in June, which was also above consensus of 3.4%. However, July services CPI inflation dropped sharply to 5.2% year on year in July versus June's 5.7%. The data details also showed that the largest upward contribution was from housing and household services, where prices of gas and electricity fell by less than they did last year. The largest downward contribution came from restaurants and hotels, where prices of hotels fell this year, having risen the previous year. The Bank of England had said it expected inflation to rise further this year, reaching 2.8% by December, as the temporary drag from energy prices fades before falling back again. In the Eurozone, inflation also went up to 2.6% in July from 2.5% the previous month. The Central Bank of Nigeria gave the nod to the merger of Unity Bank and Providus Bank with a 700 billion naira loan package. The support package strengthens Nigeria's financial system and avoids potential systemic risks, according to the CBN. It is the second merger since 2019 after the Access Bank Diamond Bank deal and creates a 243 branch entity with asset size of about 2.43 trillion naira and 848.9 billion naira deposit base. The new bank still requires 151.8 billion naira in recapitalization funds to meet the central bank 200 billion naira capital requirements. But the tidier balance sheet has a better chance of raising the additional capital. Senior business analyst Lekon Shote comments on this deal.
We shouldn't really be surprised that Unity Bank is going to be taken over by another bank. You see, out of the 9 legacy banks, 5 of them were owned by Northern Nigeria interests, either government or private individuals. And then the first managing director was deputy managing director of Bank of the North. And Bank of the North, yes, was registered as a commercial bank. Also, New Nigerian Bank was also registered as a commercial bank. But they pretty much operated almost like development banks, and they were not too strong on risk assessments, consideration of collaterals, and requirements for payments. So many of those banks actually ended up with large portfolio of non-performing loans. And that was why they had problems. And that was why they all came together and formed Unity Bank of Nigeria. Now, the dominant culture, those 5 banks owned about 65% of the shares of Unity Bank. And the dominant culture was that of Bank of the North, which incidentally had owned just about 3 or 4%. But the culture of indulgence was very strong within that bank, and it continued into the Unity Bank. And so, like I said, one should really be surprised at that this happened. And then Providus Bank showed up. And some people wonder why Providus Bank, that is less than 10 years old. Well, this had happened before. Standard Trust Bank took over UBA, one of the big 5. And so it's not really a surprise that this is happening again this time. Now, is Providus Bank making a good investment decision? Oh, yes. 1, Providus Bank has a very lean workforce. They have about 6 or 7 or 8 directors. Only 2, the managing director and 1 executive director, are executive directors. The others are non-working directors, including the chairman. And they are all very, very thorough professionals. And they are doing well in their private businesses wherever they are working. And they bring in serious professional discipline into the management of Providus Bank. So that's one strength. 2 is that in spite of the problems of Unity Bank, it has a very large number of bank branches in northern Nigeria. And in addition to that, most of its customers are SMEs, which incidentally is one of the focus of Providus Bank. So there is a synergy here. And I think it's very likely, if they continue with the disciplined approach and impose their disciplined management style into the new, bigger Providus Bank, I think they'll be able to rein in a lot of the excesses of Unity Bank. And I believe that they will be able to take over a lot of, recover or recall a lot of the loans that have been given out. And I think it's a good thing that the bank is not allowed to collapse.
Indeed, there are three principal issues with mergers. First is the strategic and cultural fit. Successful mergers are driven more by a compatibility and synergy that adds value from the marriage. If Providus Bank wants to be a nationwide branch bank with presence in all the corners of the country, requiring a network of profitable branches, then there could be some sense in this merger. The strength of banks are increasingly in the quality of assets, customer base that enables access to cheap source of funds, and disciplined management processes such as assets and liabilities management and risk management, as well as technology-enabled operations. Sprawling spread of unprofitable branches can be a drag. Second, a bigger bank is not necessarily a better run one. This is also where cultural assimilation tends to be an issue. Where there is a cultural fit and alignment, there is a better chance of success than where you hope a bad bank can be redeemed by a good bank. Third, a marriage driven by survival or convenience rather than by strategy can be problematic in future. After the challenge of raising capital subsides, the realities of two odd partners trying to live together with different values can lead to tensions. My advice is not to underestimate the cultural dissimilarities and the efforts required to envision afresh to address today's contextual realities instead of being held back by legacy service paradigms. There are also many softer cultural change issues that need to be managed beyond the numbers. For the central bank, the future of banking is increasingly linked to a new digital age with new approaches and technologies requiring fresh thinking and the encouragement of a new generation of banks that are now emerging with more informed approaches to risk and assets and liabilities management, which puts talent also at the center of strategies. Also, as we transition away from branch-based banking to this new digital, far more effective service delivery models that also promote inclusive economic growth. The world is at the cusp of evolving something different in banking. Regulators should help incubate this process, and sometimes the older models have to be allowed to die out. Providus Bank is said to be ahead in its technology assimilation. Let's see how that will work out, especially as it leverages that savvy. Also, the greater challenge to Nigerian banks is the weak external economic front. A slow-growing economy beset with high interest rates and other inflated costs and FX instability can have very adverse risk implications that cannot be ignored. Comprehensive de-risking of the environment with better infrastructure and market attractiveness for investors is therefore more of an imperative than injecting billions in what could be a drain pipe. Central Bank announced that it was reintroducing the publication of several key economic indicators, including Purchasing Managers Index, Business Expectations Survey, Inflation Expectations Report, and other macroeconomic indicators, which can provide stakeholders accurate insights and also provide data-based evidence to support monetary policy narratives. Asian stocks mixed as the Reserve Bank of New Zealand cut benchmark lending rates, and Japan's Prime Minister Fumio Kishida announced stepping down in September. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and following. Bye-bye.